morning everyone. Welcome to this morning's training session on capital gains tax. Now, the reason we want you guys to understand or have a basic knowledge of capital gains tax is every time a property, a client, whether they living in the house themselves or selling an investment property, clients will often ask you, how will the sale of my property influence my capital gains tax? And it's not expected of an estate agent to be a professional accountant when it comes to capital gains tax knowledge, and because it can, you will see, it can get quite complicated. But as a property professional, what is expected of you is to have a basic knowledge of what capital gains tax is about, so that you can advise your client more or less, depending obviously on different circumstances, but more or less what they can expect to pay to SARS in terms of capital gains tax. So the basics, the fundamentals of it is actually very straightforward. Where it gets very complicated is, or it can get complicated, is if the client lived in the house as his primary residence for a portion of the time and leased it for another portion of the time. So in other words, it was an investment property and he then moved into it eventually, or vice versa. Or when the client might be living overseas, when it's a non-resident selling a property in South Africa, then it can get quite complicated. And then I would advise you to tell your client to go and see a professional accountant to assist them. But with basic, normal, straightforward transactions, you can use the information that I'm going to share with you today. So let's get going. Capital gains tax. When is capital gains tax chargeable and payable? Now, firstly, capital gains tax is just you basically add an amount to the person's normal income tax. So you'll see it's not an additional tax on top of income tax. It's tax, the profit, the gain that the client would have made on the property, on the asset, will be added to their normal income tax and then taxed according to their normal tax bracket. So it's an addition to their income tax. It's not a separate tax like VAT, for example. So it's chargeable on disposal of an asset. So obviously real estate is an asset. So when the client sells his property and he made a capital gain, a profit on it, then capital gains tax come into play. It's when there's change in ownership of an asset, in other words, on that property. It's taxable on the capital gain, and that capital gain is included in their taxable income for the year of assessment. So when they do their tax return with SARS, they will include the capital gain that they've made on the specific property. And there's different portions. The inclusion rate will differ, as I'll show you later on. It's different for an individual, different for a CCPTY, limit trust, etc. But we're going to get to that. A capital loss, obviously a client can make a capital loss as well, but a capital loss cannot be set off against your income tax. So they add the capital gain, but you can't deduct the capital loss. However, a capital loss will be carried over, it can be carried over from tax year to the next tax year, and when you eventually do have a capital gain, then you can set the capital loss off against the capital gain. But it's not allowed to deduct any capital loss from your income tax. Okay. From which date is capital gains tax payable? Now, capital gains, it's fairly new. It came into legislation in South Africa on the 1st of October 2001. So if your client obtained his property, bought his house, inherited his house, whatever the case might be, prior to the 1st of October 2001, and he eventually sells, he will need a valuation of that property to determine the value on the 1st of October 2001, because that's when capital gains tax came into effect. So it said that you need a professional opinion. What a professional opinion is, I know back in 2001, us estate agents had to do lots of valuations for clients for capital gains tax purposes at that point in time. But it can be done via a sworn valuator or an estate agent, but the client will need a valuation on his property as per the date 1st of October 2001, should he have purchased the property prior to this date. So if the asset was obtained prior to the 1st of October 2001, the seller will need a valuation for the property reflecting the value on that date. The seller will then only be taxed on the capital gains from 1st of October 2001 until the date that the property has been sold. Very straightforward. Any questions so far? You're all with me. Who is liable for capital gains tax? Now, individuals, a natural person, plus legal entities, companies, closed corporation, trusts, etc., are all liable for capital gains tax. If you're a resident in South Africa, you're liable for capital gains tax on assets located in South Africa as well as assets located out of South Africa, overseas. So if that client sells his holiday home in Bali, but he lives in South Africa, he's a South African resident, he's still liable for tax on the capital gain on that property in Bali. And if your client is a non-resident, and so he does not live in South Africa, he's liable for capital gains tax on assets situated within South Africa. So not living here, the property is here, still capital gains tax. But living here, no matter where your property is situated, you have to pay capital gains tax on it. Now, how do we calculate the capital gains or the profits that the client made on the property? Now, your client needs to determine base cost. Now, base cost is what the client paid for the property. So that's obviously the amount, what is sold for, less base cost will be the profit, the capital gain. So what can the client include in base cost? The base cost is the cost of an asset which is to be deducted from the proceeds of the sale to calculate the capital gain. So it's firstly the purchase price, what that client bought that property for. And as I said, if he bought it before 1st of October 2001, the value of that property on 1st of October 2001. He can also add transfer costs, the transfer fees that he paid on top of the purchase price to purchase that property can be added to base cost. Agent's commission that he may have paid when he bought the property, and also agent's commission that he paid when he sold the property can be added to base cost, because it's all expenses that made his gain, his profit on that property less. So that's part of base cost. Cost of improvement or enhancements of the property. But keep in mind that it's got to be of capital nature. So if it was maintenance done, then it's an expense. You didn't improve or enhance the property. And the client would have deducted that anyway from his normal income tax. So, but if it's of asset value, he increased the value of the property, he built on, etc. An improvement or an enhancement, it can be added to base cost. So you understand the difference between the two, whether it's an expense, a maintenance, which you would have deducted from your income on your normal tax return annually, and whether it's of asset value, then it can be added to base cost. Expenses such as interest, repairs, maintenance, insurance, rates and taxes, etc. are usually already deducted from the taxpayer's income and are therefore not allowed as part of base cost. So you're all with me, you understand how we determine base cost. Okay, who needs notes still? Everybody's got. Okay, now there's certain exclusions. There's amounts that the receiver of revenue allow as a deduction from your capital gains, whether it's your primary residence or not. So this is what's allowed always. So for non-primary residents plus primary, you'll see now as we go along. For non-primary residents, it's not your primary residence, then SARS will allow the following. This would be such as an investment property, and in other words, a property that's leased out, or a second residence, such as a holiday home. Now, in those cases, your annual exclusion is 40,000 Rand of the capital gain or loss for a natural person or special trust. So only if the property is registered in the name of an individual, a natural person, or a special trust. Now, a special trust is a trust that's specifically formed for a disabled person, a person that cannot earn income. Now, SARS sees a special trust the same as an individual. So if it's an individual or a special trust, 40,000 Rand, the first 40,000 capital, or 40,000 can be deducted from the capital gain. Instead of if a person passes on, and in other words, if it falls in an estate, a deceased estate, then that 40,000 increases to 300,000. So that's only allowed if that individual passed away in that year. Yes, I think the annual shouldn't be there, Marisha, in front of the 40,000. That's just a straightforward 40,000 when you sell it. The annual is only in the year of when the person passes on. Okay. Furthermore, this 40,000 deduction is not applicable to a company, a closed corporation, or a normal trust. It's only if it's an individual or a special trust. Okay. Now, if it's the client's primary residence, then the first 2 million of the capital gain or loss on disposal of the primary residence must be disregarded for capital gains tax. In other words, let's say the house sells for 4 million, base cost is 1.5 million, and the capital gain is 2.5 million, and it's the client's primary residence. Then the first 2 million is excluded, so the remaining 500,000 is subject to capital gains tax. So you all understand that too. On your primary residence, the first 2 million is not subject to capital gains tax. Next, what is a primary residence? Where can a client qualify for this 2 million deduction of his first profit? Firstly, the property must be registered in an individual's name. So it's got to be owned by a natural person. If it's owned by a legal entity, PTY Limited, CC Trust, etc., you cannot claim the 2 million exclusion even if it is your primary residence. So only if the house is registered in an individual's name. It also must be used as a place of residence by the person in whose name it is registered. So that person must be living there permanently. Land does not, also if land exceeds 2 hectares, if it's like a plot or a farm that's bigger than 2 hectares, you do not qualify for this 2 million Rand exclusion. And if it's 2 hectares or less, the land itself must be used mainly for domestic purposes by the person living in the house. So in other words, if I've got a little house here on this plot and I rent out the land for farming purposes or whatever, then I'm not allowed to claim the 2 million exclusion. Also, it can only be claimed for one residence at a time. So if you a person, let's say you work in Johannesburg and your family stays in Pretoria. So you've got a house here in which your family stays, and then you've got an apartment in Johannesburg in which you stay during the week. When you claim your 2 million exclusion, you can only claim for one property at a time. So if you sold both in the same year, it's the one or the other. You cannot for the and if you live in the one for a partially and the other partially, then you will split the 2 million up between the two properties. So you can only claim for one residential property in a specific time frame. Also, if a portion of the property is used as an office, then the 2 million exclusion will not be applicable to that portion. So then, if more than 50% of the house is used as an office, the 2 million will be excluded. You can't claim it at all. But if it's less than 50% that's used as an office, you will calculate the pro rata on that 2 million based on the square meterage of the office portion and the residential portion. Okay. Also, as we said, it cannot be registered in a trust, a company, or a closed corporation. So it's got to be registered in an individual's name. Primary residence exclusion on joint estates. Now, a joint estate is usually when it's husband and wife. The property is registered in both husband and wife's name. So what do we do then? It's still registered in an individual name, but how do we split the capital gain and the 2 million exclusion? For example, primary registered in a couple's name, married in community of property, so it's a joint estate. Disposal will be treated as having been made in equal shares by each spouse, and the primary residence exclusion will be apportioned between them. So let's use an example. The joint proceeds is 4 million. That gets split up half between the two spouses, husband and wife, 2 million, less base cost, which in this example is 1 million. So the capital gain is 3 million, which is split up between the two partners, or the husband and wife, and they each get a 1 million exclusion in terms of their primary residence. So each person's capital gain will be 500,000. You all understand that? Okay, primary residence owned by a company, CC, or trust. We said the 2 million is not applicable only if the property is registered in an individual's name. What if I've got more than one primary residence? You've got to choose one, always only one, for a specific time frame. You cannot claim the 2 million exclusion for more than one property within the same time frame. Pro rata calculations. For example, the house was leased for a period but now became the client's primary residence. Assume the taxpayer leased the property for 1 year and then lived in the property himself for another year before he sold it. The capital gain on such property is 3 million. The property was leased for half the period and the taxpayer used the house as his primary residence for the other half. Therefore, 50% of the capital gains will be apportioned towards primary residence and 50% towards non-main residence. Therefore, capital gains towards primary residence, our capital gain was 3 million, so 1.5 million, less the 2 million exclusion for primary residence for the period that he lived there himself. Then there's no capital gains tax on the portion for primary residence. And then the capital gains tax towards non-primary residence, 1.5 million, half of the capital gains, minus the 40,000. Remember, you get the 40,000 exclusion. Then the capital gain is 1.46. And then the capital gain inclusion on his taxable income, his normal income that he declares to SARS on an annual basis, he would add 40%. Because we'll get to it now, on an individual, your inclusion rate is 40%. So 40% of that capital gain must then be added to his normal annual income, and then you'll take his annual income and calculate his tax liability in terms of the tax bracket that he falls under. Okay. SA residents selling a property outside of South Africa. You calculate your capital gain in the foreign currency and then convert it to rand at the current exchange rate, the date of registration, the exchange rate on that date. For example, he buys a property for $1,000 and then sells three years later for $5,000. Capital gains is $4,000. You convert the 4,000 to rand at the exchange rate on the date of registration, and this is the capital gains amount. That's how you calculate when the client sells properties overseas. Non-resident selling a property in SA. Now, usually the transferring attorney, and you'll see the last clause of our sales contract also refers to this. The transferring attorney will withhold from the seller, the non-resident, the person who's not living in South Africa, 7.5% of the amount payable to the seller if that seller is a natural person. They withhold that and they pay that to SARS. 10% of the amount payable if the seller is a company, and 15% of the amount payable if the seller is a trust. Okay. This will be paid to SARS as an advanced payment towards the seller's liability for normal income tax for that year of assessment. If the seller does not want that, he may apply for a directive from SARS that no amount or a reduced amount be withheld and paid to SARS, but this must be done prior to registration and shared with the transferring attorney. So if that tax directive is not already in place on registration, this is how the attorneys will handle it. They will withhold that percentage and pay it over to SARS. Which portion of capital gain is added to a taxpayer's taxable income? Now, on an individual or a special trust, I've explained to you what a special trust is. A person, the beneficiaries of the trust are disabled, they cannot earn income themselves. Now, the inclusion rate on those individual special trusts is 40%. On a company, closed corporation, or normal trust, it's 80%. On a micro business, and our micro business can be a sole proprietor, a company, or a CC with an annual turnover of under $1 million, the inclusion rate is 50%. On a special trust, 40% as well. Normal trust, 80%. So that's the different inclusion rate. So you take your capital gains and you multiply it by that percentage, and that's the amount that the client will add to his taxable income for that year. Okay. Then I've shared with you the current income tax rates. There's the income tax rates for an individual, so there's different brackets for different income levels. So let's say my capital gains is $1 million and it's registered on my personal name. 400,000, 40% will be added to my income tax, and depending on where I fall here on the income tax bracket, you will be taxed accordingly. Okay, so it's just normal tax brackets that the person pays according to his income. The income tax rates for legal entities, companies, closed corporations, for the current tax year is 28%, and for trust is 45%. So we've shared that with you. And then there's also an exclusion for businesses, small businesses. Now, small business or corporation is taxed differently. To qualify for this lower tax brackets, the small business must be a corporate entity, a closed corporation, private company, or personal liability company. All shareholders of the entity must all be natural persons, so it can't be a trust holding shares in a company, for example. The entity may not have a turnover of more than 20 million per annum, and the shareholders may not hold shares in other companies. And the entity might also not be a personal service provider. Now, I think that is like a doctor or an architect or an attorney. And then they get taxed differently according to that, the tax brackets as shared with you. So, in a nutshell, to explain to you, you take your capital gain that the person made, the selling price less base cost. You first deduct any potential exclusion, such as the 2 million rand primary residence or the 40,000 rand allowed for the instances that we've discussed. You then take that amount, multiply it by the inclusion rates, then that gets added to the client's taxable income, and his taxable income is then taxed according to the tax bracket that it falls under, or the percentage if it's a CCPTY limit or trust. I think that's, as I said, it gets quite complicated when he leased the property for a portion, lived in it for a while, maybe moved out again. In such instances, you can give him the basics that I've shared with you, but advise him to go to a tax practitioner then. And also if it's a foreigner, but I think this is as much as what is expected from a real estate agent to know and to advise a client when they sell their property. Thank you. Any questions? Any other questions, guys? You've got, you have a basic knowledge now of capital gains tax. You should be able to answer a client. Okay, awesome.